Are you a trader struggling with determining the trend? Are you also struggling to find the rightful supply and demand zones in the market? Is getting entries something futile? If so, this is the right video for you. Welcome to Bunnex Investment Group and consider subscribing if you haven't done so. And don't forget to click the notification bell icon so that you'll be notified each and every time we upload a new video. On that note, let's actually jump into our today's video. So in this video, we'll go through these topics. We'll first define the 200 EMA, then define the 200 EMA strategy and give the strategy parameters, and the last but not least will be a chart example. So if you want to know how exactly you can apply the 200 EMA on the charts, as well as how to trade using the 200 EMA, make sure you stick up to the end of this video. So the 200 EMA, also known as the exponential moving average, is an indicator that tracks the 200-day price move to determine trend. It is an indicator that can help to make our decisions since we can see where the market is actually flowing. So it's an indicator that can track 200-day price move to determine whether we are in a downward trend or we are in an upward trend. So there is a popular saying in trading that states, always trade with the trend. Make the trend your friend. So it is available on all trading platforms, usually as a built-in indicator. That is MT4, MT5, C Trader, Ninja Trader, even the Trading View, it's available for free. So here is the 200 EMA strategy definition. Since we defined the 200 EMA as a trend setter, we'll utilize this property. Actually take advantage of the property that it can show us the 200-day move trend. So whenever we see the market below the 200 EMA, it is a sign that the market is in a downward trend. And whenever we see it above, it is also a sign that it is an upward trend. So it is not wise for us to enter the market blindly or just the market impulses, but wait for the market to give us a proper pullback and the 200 EMA retest to act as our entry point. So what we mean is we need to see, let's take for instance, this is the 200 EMA. We need to see the market either going down, crossing over the 200 EMA. This will become our first sign that we are now in a downward trend. We must not enter in such an impulsive move because the market will always pull back after inducing traders. So the next thing is to see the market come back to the 200 EMA to retest that 200 EMA, and this becomes our zone of market interest. That is where we would look to get into the market for a possible continued move. So the retest can be seen on the H1 time frame. Why the H1 time frame? It's actually a time frame which is median, both short term as well as long term. So below is a chart that summarizes the above explanations. In this case, we can see this particular price move on euro against the US dollar. From this point, we can see that the market went below the 200 EMA, which was an impulsive market cross below the 200 EMA. After that, we can see a price pullback to the 200 EMA to give us a zone of market interest where we are looking to get reasons for entry within the market. So let's go ahead so that you fully comprehend and understand how to utilize this. So here is the strategy definition. These are the instructions of how to use the 200 EMA in your trading. The H1 chart must show a market crossover of the 200 EMA up or down, right? Wait for the move of at least 1 day, then a market pullback. So after the crossover, we need to see at least a day so that we won't find ourselves in market consolidations. Then the market retest on the 200 EMA will give us a zone of interest where you would expect a candlestick reversal pattern for your entry. There are several candlestick reversal pattern, bullish engulfing, bearish engulfing. It's up to you to choose which ones you focus on. So as said earlier in the video, this is now the chart example of the particular 200 EMA strategy that we have been talking about. The first thing, as we said on the chart, on the slides, is to see the market shifting or crossing over the 200 EMA. In this case, we can see the market going above the 200 EMA, and this is the first sign that we are now in an upward trend. After a day with of the market crossover, we now need to see the market pulling back. To pull back, it retested on the 200 EMA, and our 50 pips was actually bagged. Then it came back again, it bounced on the 200 EMA, another 50 pips was actually bagged. So this is actually what is in front of you, something that you can also apply on your charts. We can see that from this point we have the market crossover with the 200 EMA, and the market actually came back to retest the 200 EMA, and 50 pips was actually bagged at this point. Although the market went straight down to this point, probably you are going to get more than 110 pips, but we always take what we have been given. Then at this point, we can see that the market attempted to go above the 200 EMA, but as we have said that we need a day for us to actually consider it a crossover. Moreover, we need a market impulsive move, which is basically a sign of induced traders taking part within the market. So this was actually something that could not be validated. Then this one, still considering this market crossover to the downside of the 200 EMA, this was going to offer us another entry point, and the 50 pips was going to be hit. At this point, we had an impulsive market rise, right? On this impulsive market rise, we could actually say we are now above the 200 EMA. As you can see, the price was now playing above the 200 EMA and went back to the 200 EMA. However, it went down again, and this was a negative 25 pips that was going to be incurred on that particular trade. Then since the market is now below the 200 EMA, we could get this as our entry point, and 50 pips was going to be hit, another entry point, then another 50 pips in the back. Then we go down, we can see that at this point the market came back again to the 200 EMA. However, we could not reach 50 pips at this point. So whenever we reach 25 pips to 30 pips, we need to move our entries to break even, so that we protect our accounts. So at break even, it actually dropped around 44 pips, and at that point we had our stop losses at break even, and it was taken out. So at this point we can see that the market went above the 200 EMA. So it is the play of the market makers that at some points you'd see that they fail to come and retest the 200 EMA, and it's all good because we don't have control over the markets. We always wait for our edge to play out. At this point, the market actually came back to the 200 EMA, retest, and gave us the 50 pips. Then at that point, we can see the market went below the 200 EMA, came back to retest that 200 EMA, and our 50 pips was actually bagged. So as I always say, you must not take any strategy and do it blindly on your live accounts and learn something new. You need to go back and backtest, and for this strategy to fully function and be very useful, you need to at least incorporate the concepts of levels counting, and that is what we teach in the private classes. And if you really need to understand the whole thing, make sure you check out our free Telegram channel. The link is right below, where we share free signals, support, as well as announcements for any upcoming classes. On that note, we come to the end of this video. Thank you for watching. Like and subscribe.